Welcome to another episode of AlphaCall, where we go beyond balance sheets to uncover the real story behind the numbers. And tonight we are breaking down the second quarter results of Steel Authority of India Ltd, or SAIL, India's largest state-owned steel producer. On the surface, sales numbers show steady growth. But if you dig deeper into the Q&A, this quarter reveals a company that's quietly deleveraging, squeezing cash from hidden corners of its balance sheet and preparing for the next leg of expansion. First, let's begin with the scorecard for Q2 26. Revenue from operations came in at 26,524 crores, up 8% year on year. EBITDA 2,829 crores versus 3,174 crores last year. EBITDA margin was 11% for first half of FY26, broadly stable despite pricing pressure. Profit before tax after exceptionals was 553 crores, and profits after tax came in at 427 crores versus 834 crores last year. For first half of fiscal year 26, PAT, or profit after tax, stood at 1,112 crores, up 32% year over year on the back of lower finance costs and higher volumes. Debt, according to India AS or Ind AS, was 33,663 crores with a debt to equity ratio of 0.6x and a DSCR of 3.48. Interest cost was down sharply to 484 crores this quarter from 758 crores in Q2 of last year. So that decline in finance cost was one of the most discussed points in their earnings call, and it came from real debt reduction, not accounting optics per se. So what were the key management commentary? So the Director of Finance, Mr. Ashok Kumar Panda, who also holds additional charge of commercial operations, did set the tone early. To quote him, he said, during the first half, we reduced borrowings by over 3,000 crores, and that's where the interest burden came down significantly. Basically, the company's sales volume jumped 15% year over year to 9.46 million tons, while production of crude steel stood at 9.5 million tons. With improved operating efficiency and stable raw material costs, SAIL has managed to offset weaker steel prices. Let's move to what really came out in the analyst Q&A, the questions that actually mattered, because that's where the alpha lies. So first one, realization versus steel price decline. Analysts noticed that while benchmark steel prices fell steeply, sales realizations held up better. Mr. Panda explained that this was due to higher volumes of byproduct and scrap sales. The company aggressively auctioned defective, rejected, and waste steel, unlocking 1,140 crores from byproduct sales in Q2, and that's up from 869 crores in Q1. Roughly 20 to 25% of that gain flowed directly to the EBITDA, cushioning the hit from lower steel prices. Second was inventory cleanup and working capital. Finished steel inventory now stands at 1.9 million tons, down from 2.7 million tons at the start of the year. The in-process stock has nearly halved from 1.3 million tons to 0.7 million tons. Now, this working capital release was a big enabler of debt reduction. Mr. Panda said the focus in Q3 and Q4 is to sell faster than they produce, continuing the inventory liquidation and further reducing the borrowings. Third one, demand outlook. On pricing, Mr. Panda was realistic. He said there is pricing pressure on steel prices globally, but from mid-November onwards, they expect demand to pick up and prices to improve. The management expects better realization in second half, helped by post-festive infrastructure demand and range-bound coal prices. So imported coal averaged 17,400 per ton in Q2, and the company expects only a modest rise to around 18,000 per ton in Q3. The fourth one was about capex and expansion plans. And this was the most detailed part of the Q&A. SAIL has spent 3,370 crores on capex in the first half, ahead of its target, and aims for over 7,500 crores for fiscal year 26. The next major project is the IISCO steel plant expansion, 4.5 MTPA brownfield capacity with an estimated cost of 30,000 crores. Tendering and order placements are nearly complete, and physical work is expected to begin in fiscal year 27. Beyond IISCO, SAIL is pursuing debottlenecking projects at Rourkela, Durgapur, Bhilai, and Bokaro aimed at incremental capacity gains and efficiency improvements. And when asked about long-term debt strategy, Mr. Panda said that they are targeting a debt-to-equity ratio of 0.35 to 0.4 by year-end before new capex ramps up in FY27. From then, the borrowings will rise again, but for growth. For these expansions, will follow a 50-50 debt to internal accrual mix. The fifth major theme was value-added products and mix shift. SAIL's value-added steel share has risen from 55% in Q1 to 57% in Q2, and management is targeting 60% plus by Q4. And this pivot towards higher margin products is critical as base steel spreads remain volatile. And as Mr. Panda put it, they are focusing on value addition across all 5 integrated steel plants, and that's where margin stability will come from. Sixth one was around iron ore and mining. So SAIL has begun monetizing its iron ore dumps, around 33 million tons of fines from the Dalli Rajara region via dispatches to sister plants and external auctions. It also sold 0.3 million tons of iron ore from Bolani mines during the first half, with more auctions planned as new mines like Rawaghat ramp up. This not only creates incremental revenue but also improves raw material integration across plants. So, what were the operational snapshot? Let's quickly look at that. Crude steel production was 9.5 MT. Saleable steel was 9.6 MT. Domestic sales 9.28 MT. Exports 0.18 MT. EBITDA margin, as I earlier said, 11%. EBITDA per ton was 6,081. Debt to equity was 0.47x. The outlook. So management expects Q3 and Q4 to show margin improvement as sales volumes stay strong, inventories drop further, and prices stabilize. Fiscal year 27 will be a bridge year. Moderate growth, let's say 5 to 7%, higher capex, more than 10,000 crores, and the start of IISCO's expansion rollout. Coal prices and the rupee dollar trend remain watch points, but internal cash generation and cost reduction provide a cushion. So, in closing, this isn't a story of spectacular profit growth. It's a story of financial discipline. SAIL is monetizing waste, paying down debt, and prepping for a new capacity cycle, all while navigating a volatile global steel market. And if the company holds its course, that is keeping leverage below 0.4x while funding capex from cash, this could well be the most balanced phase of SAIL's modern history. That is the AlphaCall takeaway for SAIL's second quarter fiscal year 26. I'm your host Radhakrishnan Chonat. Thanks for listening, and do subscribe for more such insights. As a friendly disclaimer, this is not investment advice.